It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com or the Your Personal Bank app. Yes, you will reach me. It's yourpersonalbank.com. Each week, I try to share some stories of some of the folks I've met with this past week, and I have some really interesting ones for you. I'm going to encourage you to stay tuned. If you've been listening to the show for any period of time, you know I've been sharing this as the golden age of fixed assets. This is literally the best time in over 40 years to look at index products, index annuities, index life, high cash value, dividend-paying life policies. We're getting the highest returns seen in over 40 plus years. We have index products that actually have averaged over 10% annually over the past decade. Some of our one-year returns have been as high as 26% in 1 year, all with no downside market risk. This is why people are reaching out to me more than ever. These products have become more popular than ever. Many of the negative connotations or limitations that these products had in the past have been improved. There's been some recent improvements after the first of this year, 2026, where they've been improved even further. Again, there couldn't be a better time in your lifetime to look at these. We have products with unlimited upside potential gains, no fees, and no downside risk, tax deferral or options that are even tax-free, some that are highly liquid also. Depends on what you're looking for, what your goals are. If you haven't looked at index products in the last couple of years, you really should take another look. The cases I've been dealing with just this past week, for example, if these clients had met with me a decade ago, their actual returns, net of everything, in their pocket, would have been more than double than what they've been receiving, all without downside market risk. It's pretty powerful. And if you do want to meet with me, I can show you how the sausage is made. I have 2 proprietary programs that I'm told less than 1% of agents and advisors have access to. This is the difference maker. I have index performance reports that show 1, 5, and 10-year actual returns on hundreds of indexes. This is proprietary info, and it's not public, and it's very difficult to obtain. Frankly, without this, an advisor or an agent is flying blind, and it's game-changing. Also, I'm totally independent. I have access to nearly any company out there. I have access to over 50 companies and hundreds of products, literally, and hundreds of indexes. I'll show you exactly what I see. It'll be abundantly clear and obvious when you look at this and realize why I'm able to help ensure my clients receive far greater returns than the average, almost regardless of what other investments you've had over the past decade. So if you're interested, contact me at yourpersonalbank.com. I'm going to get into sharing those examples a little bit further and some more details in a bit, but I want to touch on a few key economic things that are happening currently. When it comes to housing, for example, do you realize that the qualified home buyer pool has actually shrunk in half over the past 5 years? Currently, only 25% of U.S. households have the income to qualify for a typical FHA entry-level buyer mortgage. This is down from 47% in 2019. And the reason why this is happening is a household needs to make a minimum of $132,000 to afford the median home today. Only 31% of households can actually afford a median home. And 77% of the households that are earning $132K or more already own. Bottom line is 50% of the housing market is chasing about 7% of the home buyers that can afford a home that they do not already own. The predictions are housing prices, it's not going to be pretty, folks. And I get asked this quite often, but many of the professional real estate projection programs out there are showing in many parts of the country anywhere from 10 to 20% additional price reductions projected for 2026, below from current prices, especially if you're looking at places like the Southeast, the Southwest, Texas, Florida. The primary exception to that rule is the Northeast. There's still a shortage of homes in the northeastern part of the country. That is not true in the Southeast or the Southwest or the West Coast for that matter. And you have a number of reasons behind that why There's not a housing shortage. Builders have been building more. For the first time in something like 50 years, we have a net decrease of population. A lot of this is due to deportations and voluntary deportations. Regardless of what you think about that, they have an impact on housing prices. Rental prices have dropped nearly 10% nationwide on average from a year ago. There's a direct correlation. When you have over 2 million people leave the country, there's less demand. It's not political, it's economics, it's math, it's basic supply and demand. That trend shows no sign of changing. In fact, ICE has hired many more agents. They didn't really start enforcement until about mid-2025. They're going to have the entire year with a much larger force, more well-funded, and many of the legal challenges behind them now to be able to deport more people in 26 than 25 even. That'll likely lead to more people leaving voluntarily also because they've increased the amount of money to pay illegals who are willing to leave voluntarily. All these things are going to have an impact as we move forward. Now, you have another big issue that a lot of people are not paying attention to, and that has to do with government debt. I've shared this quite often on this show, but not recently. And why this is so important is it turns out that 26% of the U.S. federal debt is maturing in the next 12 months, which is nearly the highest level in over 26 years. In the next 12 months, over $10 trillion of U.S. federal debt will have to be resold. Now, what do I mean by that? It'll have to be refinanced. The federal government owes about $38 trillion. And they sell it in various government bonds, anywhere from 4-week term to 30 years and everything in between. The government is promising to pay you a certain interest rate for a certain period of time, again, much like a CD. And when that bond matures, the government doesn't pay it off. They just resell it on the bond market at whatever the current interest rate cost is. When we go back to basic supply and demand, you have all-time record supply of bonds. How do you entice these bond buyers to buy more? You have to raise the interest to entice the bond buyers. This is why you're seeing bond yields or bond interest rates remaining on the higher side, and why nearly every economic expert is predicting higher interest rates for longer. You're hearing the same thing from the Federal Reserve. Recently, they kept interest rates at the same level, did not decrease them. And when you have a record level of debt, bonds, you have to resell, refinance, because again, they don't pay them off. They have to resell them. In the next 12 months, that will do nothing but push bond yields higher, which will push interest rates higher. I know the Trump administration has been discussing recently pushing mortgage rates down. And even if the new Fed chair that'll be appointed in May of 2026 does reduce interest rates, what most people don't realize is the Fed really influences short-term interest rates, 2 years and less. They don't do much. They don't affect mortgage interest rates very much. Mortgage interest rates are typically based on the 10-year bond plus 2 to 3 points. The point I want you to understand is this. Don't count on the Federal Reserve lowering interest rates, lowering mortgage rates, because the government at the same time has to sell way too many bonds to allow bond yields to be reduced. Therefore, the 10-year Treasury bond is going to stay somewhat elevated, which means the mortgage rates will stay somewhat elevated. Now, there is a caveat to all this. There's something else the federal government can do. We saw this after the 08-09 Great Recession and again after the COVID shutdowns. The Federal Reserve purchased mortgage-backed securities. During the COVID shutdowns, the Federal Reserve purchased about $1 trillion of mortgage-backed securities, which helped push mortgage rates down. I could see them doing something similar to that this summer with the new Fed chair to benefit lower mortgage interest rates, not necessarily other interest rates, but certainly mortgage interest rates, to benefit the Republicans in the midterms. So don't be fooled by a lower Federal Reserve interest rate thinking that's going to lower mortgage interest rates. It won't. What it will affect is short-term rates like lines of credit, any loan that's about 2 years or less, which will benefit your personal bank policies, by the way, in 2 ways. One, With bond yields staying higher because of all this debt, this record level of debt that's going to be sold in the next year, that's going to keep bond yields higher, which means dividends are based on bond yields. Dividend-paying cash value policies are going to remain strong and likely increase. Index products will also remain strong and increase because the bond yield is what determines investments in the fixed asset world. Tie in lower short-term borrowing rates. If the Fed does reduce short-term interest rates, we could have a big win-win here coming up very soon, folks. I'm going to encourage you in the next segment to stay tuned because I'm going to explain this a little bit further because I get asked quite often, how can insurance companies with index products offer returns of 8 to 11% consistently over the last decade plus with no downside market risk? I'm going to share exactly how they do that.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
This is Ference, host of the Your Personal Bank Show. Your Personal Bank is a financial concept that allows you to grow your money insured with guarantees, income tax-free, and highly liquid. Also, you have the potential to continue to earn interest on money you invest in other assets, purchase items, or pay expenses. How can you do this? First, invest in a high cash value policy to earn dividends. If you leave money in the policy, it'll grow like any investment, insured with guarantees and tax-free. Second, we establish a bank line of credit using the cash in the policy as collateral. When you access funds, you receive them from the bank. Typically, dividends earned are higher than the interest charged by the bank. You keep the difference. This is known as positive arbitrage. If you want to earn interest on money you spent or invest elsewhere, contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So in the last segment, I was sharing a few of the bigger picture economic things that are going on with the housing market in particular. In my opinion, it's probably a bifurcated type of market when it comes to interest rates going forward through the rest of the year. What do I mean by that? Well, the Federal Reserve is not the end-all, be-all. Most people pay attention to the Federal Reserve and mistakenly believe if the Federal Reserve increases or decreases rates, that means all interest rates are going to go up or down. That's not necessarily true. The Federal Reserve influences shorter-term interest rates far more than longer-term. Think 2-year and less. Think lines of credit for most people, home equity lines of credit, things like that, short-term loans. The interest that bonds pay, known as the bond yield, affect the longer-term interest rates far more. Think anything longer than 2 years. So mortgages, for example, car loans, things like that. I'm going to make a prediction. What I believe is going to happen in May of 2026, Trump will get to appoint the next Fed chair. What I believe will happen, they will lower interest rates because Trump has been very adamant about wanting to see lower interest rates. Now, this will benefit, again, shorter-term loans, not the longer-term stuff. Part of the reason why he's so adamant about this is the federal government is the biggest debtor in the history of the world. Lower interest rates benefit the borrower, the debtor, which is the federal government. For the past year, roughly, the federal government has been refinancing their debt. In other words, the bonds that mature that they have to resell. Think that $38 trillion out there. In the next month, about $10 trillion of it will have to be resold, refinanced. They've been primarily selling shorter term, 2 years and less, because the interest rates are a little bit lower, so they can pay less interest. It reduces the interest on the debt. If the Federal Reserve lowers short-term debt, that's going to benefit the federal government the most. It's also going to benefit your personal bank policies, people who borrow money short-term but not longer-term. Trump also wants to reduce the interest rates on mortgages. Now, he has very little control over the bond market. It's much, much larger than than the stock market, in fact, many times bigger. And bond yields, bond interest rates have been pushed up because of all this debt that the government's selling, record levels. Again, how do you entice the bond buyers to buy the bonds when you have so much of it? Well, you have to raise the interest rates you offer. So that's going to keep those longer-term interest rates higher. Mortgages primarily affected by the 10-year Treasury plus 2 to 3 points. How can he reduce mortgage interest rates? Well, he can instruct the Treasury or the Fed, influence them to buy mortgage-backed securities. The Fed did this after 08-09, Great Recession, and again after the 2020 COVID shutdowns. In fact, at that time, they purchased about $1 trillion of mortgage-backed securities, which helped keep mortgage rates lower. I think they're going to play the same card again. That's the most logical thought process. Now, how does this affect you? Knowing that shorter-term interest rates are probably going to be lower because after May, knowing longer-term interest rates are probably going to remain higher because of the bond market, yet mortgages might be an exception because the Federal Reserve or Treasury will likely buy a lot of the mortgage-backed securities to push the prices down. How can you plan accordingly? A lot of it depends on what is the asset. So if we think about stocks in general, companies that borrow money short-term might benefit with the lower interest rates. If they borrow longer-term, they're not going to benefit so much. Real estate could benefit from lower interest rates if the Federal Reserve or the Treasury purchases mortgage-backed securities. Precious metals will likely suffer. Lower interest rates will likely cause those to go down. But let me share with you who will be the real winners. It happens to be fixed assets. This is the golden era of fixed assets. Best time in over 40 years that we have seen these types of returns. It's been the 1970s, folks, since we've seen this type of thing. I get asked this question all the time. How can index products like index annuities, IULs, how can they be averaging 8 to 11% average annual returns over the past 10 and 20 years with no downside market risk? How can they produce up to 26% returns just in 1 year? Again, with no downside market risk, tax favored, sometimes even tax free, depending on the product we're talking about. Why are cash value dividends increasing and likely to do so for the next 5 to even 10 years? That's all the predictions. Well, the reasons are quite simple. When you purchase an index product, whether it be an index annuity, index life, what does the company do with the money? They purchase primarily bonds. They also purchase insurance on those, so that through reinsurers, and they guarantee those bonds. The bonds themselves, the principal, the money you gave them, is safe and guaranteed. Now, those bonds generate interest. The insurance companies, some of them even own their own options trading desks, by the way, purchase options with the interest, not the principal, just the interest. Now, why is this so important? Well, you need to understand how options work. And let me give you a very simple example if you're not very familiar. Let's assume you were going to buy a stock for $10. And let's assume that stock went up in a year for 10%, so now it's worth $11. Everyone understands you got a 10% return on your money. You also can purchase an option on the stock, and let's say it cost you $1 to purchase an option on that $10 stock. And let's say that $10 stock increased to $11, in my example. That option could increase from $1 to $2. 100% increase return. And you doubled your money. So they're taking a very small amount of money to buy options that when it goes up, you can have exponential returns to the upside. What's the other alternative? That $10 stock could go to $9. You lost 10%, right? If you own the stock, everyone understands that. But what if you own the option on that $10 stock and it went to $9? Well, your option expires worthless. Now remember, the insurance company's only risking and using the interest off the bond, not risking the principal. The option expired worthless. Does the insurance company owe you any money? And the answer is no. Did you lose anything? No, the principal's still guaranteed. And what's that bond going to do the next year? Generate more interest. They're going to buy options again for the next year, and they're going to repeat the process. How can they do this without any fees? It's really quite simple. Most any decade, and on average, the markets go up 7 to 8 years, and they decline 2 to 3 years of any given decade. When those options go up, Again, they could easily double. They calculate it out so that if that index went up 10%, for example, that S&P 500 index or whatever that may be, you get a 10% return. There's some overage that's earned that the company gets to keep. That's their profits. It's also how they pay me, by the way, typically. And if the options expire worthless, again, they didn't risk the principal. They don't owe you anything either. They didn't make any money either, but nobody lost anything. So what's really cool about this is when the index cooperates, everyone wins, everyone makes money, and if it goes down, well, nobody loses. That's how you can average, depending on the index we're dealing with, 8 to 11%, literally average annual returns over the past decade plus with no downside risk. While you can get years where if you choose indexes that have no fee, no cap, so it means unlimited upside, those exist. There's plenty of those available. There are some out there with fees and caps. Please understand. Don't get confused. I'm not talking about every index out there, but there are plenty of them available. Unlimited upside, no fee, that have averaged 8 to 11% for the past 10 to 20 years. I can show you the actual returns. And this is where the sausage is made when somebody meets with me and I show them exactly how this works. When people see this, it becomes abundantly obvious. And they understand immediately how I'm able to ensure my clients maximize their returns, oftentimes 2 and 3-fold more than they were receiving earlier. Because I have access to proprietary software, less than 1% of agents and advisors have this, that show us the actual index returns over the past 1, 5, 10 years, etc. There are hundreds of indexes out there. It's impossible to keep track of them all. I get an update on this report every month. Now, without these performance reports, the advisor and the agent, they can make some educated guesses, don't get me wrong, but you're kind of flying blind. And as I often say, if you're looking at one index that's, say, average 10, 12, 15% even, we have those over the past decade, consistently get strong returns. And you're looking at another index that's only averaged 3 or 4%, and has probably never done better than 5 or 6% ever. What are the odds of that low performer all of a sudden doing 10% return in a year? I mean, it could happen, but it's pretty unusual, pretty rare, right? There has to be a significant reason, a compelling reason for that to all of a sudden do much, much better versus one that's consistently, regularly produces really well. Your odds are far, far greater, aren't they? And these are the things that we have available with these index performance reports. We can sort them by returns. You'll notice that about 80% of them out there average low single-digit returns on average over the past decade. But about 20% really shine and get double-digit returns plus. It's the old 80-20 rule, isn't it? So if you just choose some index options, and I'll show you what I see. And I'll show you why one maybe on the surface looks great and why it's a poor performer. And why a different one, maybe on the surface, may not look like the best option, but why it is. The two pieces of this, the analogy I use oftentimes is a horse race. You see, if you want to win a horse race, you need two things. You need a fast horse and a good jockey, right? Well, I put those two together. If you don't have a fast horse, you're not going to win the race. And you could have a fat, really great horse and a bad jockey also not win the race. I'm going to encourage you to stay tuned in the next segment because I'm going to share with you how to identify if you have a fast horse, which indexes you should consider, and also how to determine whether you have a good jockey or not. So stay tuned.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
I'm Ference Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com.
Concerned about market risk? I'm Ference Toth, host of the Your Personal Bank Show. The S&P 500 valuations are higher than at any time ever recorded in stock market history. This includes 1929 and 1999. We all know what happened afterwards. It wasn't pretty. Elevated valuations increase risk to the downside. Annuities and your personal bank offer unlimited upside with no downside market risk. Your principal is guaranteed. Contact Ference at yourpersonalbank.com to maximize returns, reduce market risk, increase liquidity, and reduce taxes.
Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com or the Your Personal Bank app. Yes, you will reach me. It's yourpersonalbank.com. In the last segment, I was answering some questions about why index products with insurance companies have been able to produce 8 to 11% average annual returns over the past 10 to 20 years with no downside market risk. Many of these products have no fees. They also have tax deferral. Some are even tax-free. Depends on the product and what you're looking for. Now, if you missed it, I'm going to encourage you to go to yourpersonalbank.com. You can listen to this or any of the previously recorded shows. It's also on the Your Personal Bank app. Each has its own topic. I highly recommend checking it out because I share how the sausage is made. You won't hear that most anywhere else because most people really don't understand what is going on under the hood. We can agree that insurance companies are intelligent, they're smart, they're very successful financially, they're very savvy. Some of the wealthiest financial institutions in history, literally. How do they do it? And no, it's not by selling life insurance. That's a small part of what many of these companies do. They're far more sophisticated than that. They're large institutional investors, and they provide the opportunity for average people to take advantage of what many large institutional investors do. That's the power. They're some of the biggest players financially out there. Don't let anybody fool you otherwise. And they're some of the biggest players in the bond market, which is many times larger than the stock market, which surprises many people because we always hear about the stock market. But guess what, folks? The bond market is way bigger. And the comment on Wall Street is bond market is where the smart money is. The problem is you usually need to have several million, if not billions, to play in that market and have access to the bond auctions and all that type of stuff. The beauty of the insurance products, the index products, is they allow you access to that world, and you can benefit from how institutional investors operate, how the pros operate. And that's the stuff I share with people, prospects, and clients all the time. Let me give you one little secret of the trade. If you take a large investor who does, say, investing in the bonds or stocks or whatever, very few times do they go all in on a particular position or all out. What most of them do is they phase in and they phase out. Now, different ones have different criteria, but a very common one is a third. What does that mean? When they've seen a strong run-up in a particular asset, they're not sure if it's going to continue to go up or not, but instead of waiting to see, they'll pull out a third to lock in those gains and then let the rest run for a little while. And if it continues to go up, then after a certain point, they'll hit a target and they'll pull the second third out. And then when they hits the third target, then they'll pull the third out. Again, to lock in those gains. If you've had some strong run-ups in the markets recently, particularly if you've been in precious metals, I'm seeing more and more people say gold hit over 5,000 an ounce. Incredible run it's had in this past year. A lot of people are talking about locking in the gains, taking some of it out. Can it continue to go up from here? Certainly. Could we have a correction? Absolutely. Does it make sense if you've had some profits? I've had a number of clients of mine been selling off some of their gold and silver for that matter, locking in a portion because, well, that's what the pros do. And here's another thing I want to point out about this. If you missed last week's show, I discussed a lot about precious metals because that's the hot topic now because gold hit 5,000. Silver has been taking off lately. The dollar has not been tied to gold since we were taken off the gold standard in 1971. Do you know what replaced it? The petrodollar. In the mid-'70s, the U.S. made an agreement with Saudi Arabia that they would sell their oil in dollars, which guarantees a strong demand for dollars. That's why the dollar is still the reserve currency and will continue to be so for the foreseeable future. Why? 2019, the U.S. became a net exporter. Guess what? We sell our oil in dollars. We're one of the largest producers in the world. Many people don't realize that, and that has only increased since the Trump administration has taken over. Recently, the U.S. got involved with Venezuela and has control over the Venezuelan oil reserves. If you combine Venezuela and U.S. oil reserves, that combination accounts for over 50% of the world's oil reserves. Did you know that? Trump also solidified the agreement with Saudi Arabia. If you remember, that was the first foreign trip he took in his second term. Why? To secure the petrodollar, to ensure that Saudi Arabia continued to sell their oil in U.S. dollars. They were making noise about potentially taking other currencies like the BRICS. Well, by shoring that up and then having direct control over 50% of the world's oil reserves, you now dominate the oil market. You dominate the fact that oil is sold in dollars. The intermediate and Brent crude markets where countries buy oil is all priced in U.S. dollars. This is a huge hit to the BRICS. China is not an exporter of oil. They're an importer. In other words, they buy oil, and for the most part, they have to buy it in dollars. They don't like that fact, but there's not much they can do about it, especially now that the U.S. controls the Venezuelan oil reserves. So my concerns about world reserve currency status have been largely eliminated. Well, that'll be true as long as the petrodollar exists. And folks, don't fool yourself. The world runs on oil. And until the technology at some point in the future changes that significantly, that will remain to be true. But here's the point I wanted to make about all the calls I've been getting about precious metals, gold, silver, such like that. Here's what I want you to understand. A year or two ago, nobody was asking me about precious metals, not very much. Why? What was everybody reaching out to me about and asking questions about, if you remember? It was about tech stocks, NVIDIA in particular. And what was it before that? Around 2020 to 2022, everybody was hopped up on real estate. And here's the funny part about all these cycles, is people don't realize or pay attention until the cycle is well on its way. In other words, it's already ramped up significantly, maybe even doubled in value. And then all of a sudden everybody starts paying attention and wants to know, should I get in? Now, there's two fears that motivate the markets. There's the fear of losing and there's the fear of missing out. And in some ways, the fear of missing out is even stronger. It's called FOMO, fear of missing out. And my comment is consistent. These cycles, it's nothing new. And if you've seen an asset run up where it's ran up tremendous amounts in a short period of time, maybe doubled in a year or whatever, is that the time to get in? Most cases, the answer is probably not. Most likely miss the bus or the biggest portion of the gain. And now the risk is far more elevated. Look, if you happen to be in one of these markets early on and you benefited from it, great. By the way, most people, when I talk to them and they've benefited from the real estate market, and from 2020 to 2022, it peaked about 23, or they got into the tech stocks, the Magnificent Seven, let's say in 21, 22-ish, and it peaked in 24, 25, or now gold. If you've been in it a year or so ago and now it's gone way up, they'll all say the same thing. In most cases, they just thought it was a good idea, or somebody might have mentioned something, or just pure dumb luck. Well, here's the thing. If you've benefited from it, regardless of the reason why, do what the pros do. Start scaling out. Lock in some of the gains. If it's a third, if it's a half, do an amount that makes sense for you and you feel comfortable with. Let the rest run, and if it continues going up, great. But here's the other thing I want you to understand. You realize you could lock in those gains or use other assets that maybe aren't performing as much as you'd like them to, and you could put them into an index product, and if the markets continue to go up, great, you take advantage. Unlimited upside potential, no downside risk, no fee, no cap. So if it continues to go up, great. You're not giving up the upside. That's the thing that probably the most common misconception about index products, particularly index annuities. Yeah, the old ones used to limit you. I get it. And there are some products that still have caps out there. I get it. I'm not talking about those. I'll show them to you, and I'll show you the difference. But here's the big part most people miss also, really important to understand. You can participate in the unlimited upside. As I stated earlier, I had people earn up to 26% returns in 1 year recently in some of these index products. That's not the norm, but that gives you an idea what they can do just in a year. Average 7 to 11% average annual returns over a decade plus, 10, 20 years even. But here's the key. The principal's guaranteed. You don't lose on the bad years. And give me a decade you pick. Typically, there's 2 to 3 bad years in any given decade. If you do not participate in those downturns, not only do you not lose that year, but you also don't have to retrace the following years to make back the loss. Let's be generous. Let's say there's 2 bad years in a decade. And let's say those downturns were 20%, which is considered a normal correction. And so if you have a 20% downturn in a year, how long does it take to recover to make the 20% back just to get back to even? A year? 2, 3, more? Let's be super generous. Let's say you had 2 down years, and let's say it took you 2 years to recover. You're down, you're back. Each of those 2-year periods, you made no money. All that happened is it went down and you recovered your loss. You're back to where you started. So that means in a generous decade, 4 of this 10 years, there are no real gains. If you have an index product, the down year, not only you don't lose, the amount of money you have in your account stays the same. But here's the key. Here's the best part. When it does recover, you start at the lower index number. So if your index goes down, say S&P 500 index, for example, if it goes down 10% or 20% or whatever, you start at that lower number. So the recovery, that second year, let's say the recovery in our previous example, you get to gain, you get that return. So not only the bad years you don't lose, but you also actually get real gains in the recovery years versus riding the roller coaster, as I call it, where you get the downturn and then have to recover from that. So now in our example, if you have 2 bad years in a decade period of time, you now are actually gaining 8 of the 10 years, and the 2 that were down, you didn't lose. At the end of the decade, who has more money typically? If you've been listening, you understand, you already know that answer. And you did it without any market risk. You never had to worry about losing value in your account, which reduces stress. For most people, that's a big thing. You also can get tax benefits, tax deferral, tax-free even, depending on what types of products we're talking about. There can even be living benefits built into these if you need long-term care. There can be additional benefits that are available with these products that if you need it, you got it. If you don't, you didn't pay any extra for it. These are all supplemental benefits to these products that when people really look at it, they find very, very valuable. If you want more information, contact me at yourpersonalbank.com. I'll show you how the sausage is made. It'll be abundantly obvious. You'll see the differences, which indexes perform, which ones don't, how to get the best horse, the fastest horse, how to get the good jockey to make sure you receive the best returns available in the industry. I can bring any product to the table pretty much that's available in the country. So you're assured to get the best result, the best product available, period. Stay tuned in the last segment. There's a few more things going on that affect our economy, and I think you'll find interesting.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
This is Ference, host of the Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com or the Your Personal Bank app. Yes, you will reach me. It's yourpersonalbank.com. Again, I think I had a great segment last one. If you missed it, I really shared the secret of how index products are able to produce 8 to 11% average annual returns over the past 10 to 20 years, literally. That's money in your pocket, folks, net of everything, with no downside market risk, tax favored, highly liquid in many cases. If you want more information, again, contact me at yourpersonalbank.com. It's not complicated, but once you see how it works and how I can show you through the proprietary software, the index reports, the actual 1, 5, 10-year returns, it becomes amazingly, abundantly obvious why I'm able to increase returns for most of my clients 2, 3, sometimes even 4-fold to what they've been getting, regardless of the type of account you've had. I'm looking at brokerage accounts this past week. Past 5-year returns on the statements, 3.9%, 3.6%, 4.1%. Subject to market risk, actual returns, not what they're telling you what's on the statement. If you're just listening instead of seeing what's on there, you're not doing yourself any favors. I have products that are generating 8, 10, 11% average annual returns for decades plus, with no downside market risk. Kind of a no-brainer when you compare the two. Plus tax favored. Let's get into some other economic news that's going on. There's been a big push recently regarding property tax. I like what I'm seeing in a number of states. As most people understand, we don't tax unrealized gains. In other words, if you bought a stock, for example, and you didn't sell it, you just held on to it, well, you don't get taxed. You don't get actually taxed on that asset until you sell it. Now, if you have a highly appreciated asset like that and you want to access the benefit from it, yet not sell it and create a capital gains tax, I'll show you how to access the equity from that, benefit from it without creating any tax consequence. But unfortunately, with real estate, particularly with primary residence, people don't have that benefit. In fact, the same logic does not apply to property taxes, especially to homes. Why is it that when the value of your house goes up, for whatever reason, you now owe the government more money? If you do improvements to it, yet don't sell the property, why do you have to pay more money? If the government can take the property from you because you didn't pay them the property tax, do you really own the property, or are you renting it from the government? See, that's the only exception really to the rule on unrealized capital gains. And I like the way this direction of this movement is going. By the way, even with real estate investors get the benefits, tax benefits of depreciation. So they get some tax write-offs for owning property, yet a single-family primary residence person does not. How is that fair? Also, single-family residences are able to depreciate over a far shorter period of time than commercial. Again, why is that fair? Do we want investors involved with single-family residences more? Or would we rather have them investing more in commercial property? Again, I like the direction and the thoughts of the way this is going. Those are things that I believe should be addressed. As Trump stated recently, single-family homes are for families, not corporations. I think he's right on that. It's part of the reason why the affordability crisis has occurred, and I'm glad the administration is at least trying to take steps to address this. But one solution I believe really needs to be implemented, and I'm going to keep pounding this table until somebody hears, hopefully, commercial property depreciation schedule for investors is 39 years. Single-family residences is far shorter. They should be at least the same. And if you really want to make a difference, make it longer. In other words, instead of making it more favorable for investors to invest in single-family residences, the tax code at least should encourage our favorability for investors invest in commercial property. Now, I know real estate investors who own these single-family residences aren't going to like that. But again, do you want to live in a country where only 25% of Americans right now can qualify for an FHA mortgage? Where the average home buyer is 59? The average age of the new home buyer is 40? That's not good for society. And changing the tax code on single-family residences to more either match commercial depreciation schedule, that is, would be an easy, simple fix that would help the affordability crisis. Reducing property taxes or eliminating them altogether would obviously help homeowners. So there's a lot of things that can be done from a tax standpoint. And in general, here's the key. What government needs to look at is when they're taxing something is you tax something more that you want to limit, not the other way around. Great example. Government started taxing cigarettes. Why? Because they wanted less smokers. And right now, the way the property tax system is structured is if you improve your property, make it nicer, the tax assessor increases the tax on you because the property value went up. So the incentive is to have the crappiest property on the block. From a tax standpoint, it should be the other way around. In fact, there should be tax incentives for somebody to improve their property. These are things that need to be addressed. Now, in the continuing saga of fraud and waste in the government, some of the things I like about it is we have a lot of citizen journalists that are getting really good at investigating fraud. And we have people in government that are pursuing that fraud more and more. I heard a recent interview with Kash Patel, the FBI director. And he pointed out the FBI hotline is getting tremendous amount of whistleblower tips, citizen journalists, etc., sending documentation, information on suspicious, fraudulent activity. And his comment was, keep it coming. We're looking at all this stuff. You all are helping us. This is a great combination to reduce waste and fraud in our government spending. Because it's been identified that much, if not all, of our federal deficit and debt is likely fraud and waste, folks. If we can get really serious about it, the debt crisis could largely be curtailed. We could get to financial sanity just by greatly reducing waste and fraud. So that's the encouraging part. But here's a few additional examples. The Main Wire recently reported Catholic Charities has absolutely nothing to do with anything Catholic. It's just an NGO front to import illegals. There are numerous fake church NGOs that were paid tens of billions of dollars to import illegals. There was a deliberate effort to resettle the Somali refugees by Catholic Charities. They made a huge amount of money moving people around to places in the country that don't necessarily vote to have that happen. They're pointing out that Catholic Charities should be considered a human trafficking organization because that's what they really do. The sad part is that it has any affiliation to the Catholic Church. Lutheran Charities does this as well, along with tons of other organizations. The amount of money that was dumped into these organizations is mind-boggling. It's tens of billions of dollars. These religious organizations should disavow any relationship with these organizations, and frankly, they should call them out for what they are, human trafficking organizations. The U.S. Department of Housing and Urban Development has now identified approximately 200,000 illegals as having their rent paid by American taxpayers. And they're implementing new policies that landlords have 30 days to verify everyone living in their property as legally allowed to do so. Every tenant must be verified. This is good. I've caught some flack about this, but let me share with you why this upsets me so greatly. I want you to think about this for a minute. Our government gave illegal loans for homes, that's a documented fact, then gave them welfare to help pay for them, also fact. This left millions of Americans unable to buy homes, particularly starter homes. Now, these illegals have built up equity in these houses because they went up in value over the past few years that we as taxpayers ultimately paid for. So after about 4+ years of illegally walking across our borders, the illegals have more in equity than the average American who is stuck paying rent. Now, you tell me how that is fair. And Democrats now are mad that ICE is using Medicaid data to arrest illegals Why would they be mad? They told us that illegals weren't on Medicaid. How can ICE find them that way? Now, how did these illegals know to tap into all these government programs? That's a question I've often thought. Well, did you know there are community navigators that their entire job is assign illegals up for every benefit the government offers? Places like the Somali American Community Center, they're called navigators. They're supposed to help refugees, but all they do is simply sign them up for every single publicly available taxpayer-funded welfare program, whether state or federal. They get paid to register illegals on public benefits, and then they get a commission when they sign them up for things like Obamacare. So those people are getting paid and paid commissions for putting people onto welfare benefits that have no legal right to be on them. And I want to finish up with a couple of quick thoughts. Where in immigration law does it say you can enter illegally and stay, so long as you don't commit another violent crime? I mean, who voted for that rule? Any of our Congress people do so? No, not one. Yet, we're told that's the baseline for how much of the law Americans are supposed to ignore. How convenient. One of the biggest questions in the 2024 election was, should we enforce immigration laws or not? Trump ran on that as one of his primary issues. He won. He's the duly elected president who's doing his job by trying to enforce the laws. The left is actively trying to prevent him from doing so. Here's the real question. Do elections matter anymore? Or do we have to let people who don't agree with the law set our immigration policy, no matter what the voters want? There's a lot to be excited about this year coming up. There's a lot of reasons to be concerned. I still think we're going to see some significant volatility, uncertainty. Protect yourself. Protect the downside. Index products allow unlimited upside gains, as I've shared earlier in this show, with no downside risk. We have products that have averaged 8 to 11% average annual returns over the past 10 and 20 years. Some have earned as much as 26% returns in 1 year with no downside market risk. This is the golden era of fixed assets. There's never been a better time. Contact me at yourpersonalbank.com. Stay tuned next week to the Your Personal Bank Show for more great information. As long as it's on our money, in God we trust.
This is Ference, host of the Your Personal Bank Show. Great news. Most insurance companies have announced higher dividends for 2025. They also reduced fees. This will increase cash growth even more than before. This is the best time in over 40 years to consider a high cash value dividend-paying policy. Also, dividends are expected to increase for the next several years. Contact me at Your Personal Bank or 866-268-4422. That's yourpersonalbank.com.
Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states. Excessive unpaid loans may affect performance.
Concerned about market risk? I'm Ference Toth, host of the Your Personal Bank Show. The S&P 500 valuations are higher than at any time ever recorded in stock market history. This includes 1929 and 1999. We all know what happened afterwards. It wasn't pretty. Elevated valuations increase risk to the downside. Annuities and Your Personal Bank offer unlimited upside with no downside market risk. Your principal is guaranteed. Contact Ference at yourpersonalbank.com to maximize returns, reduce market risk, increase liquidity, and reduce taxes.